Welcome to another episode of Founders in Finance, where every episode we dig deep into the insights that shape financial success in Australia. We have real conversations with business owners, investment experts, accounting professionals, and everything in between to bring you the real world stories and insider insights to understand your financial well-being. Whether you're a small business owner, an inspiring investor, or simply looking to strengthen your financial foundations, there's something here for you. I'm your host, Ross Pocock, co-founder and financial advisor of Sternlight Financial. And today I'm joined by Adam. Adam has always had a passion for markets. While he was at university, he launched a student-run trading club, and since then he has grown his name within investment bonds and fixed income investments. On his downtime, he loves to run and play golf. I believe he just signed up for his first full marathon. So how are you doing today, Adam, and how did the full marathon come around?
Yeah, very well. Thanks, Ross, and thank you for having me. Look, it's a slow-moving beast, the marathon training, but you start small and like anything else, you slowly build up over time. So, but really happy to be here today.
Yeah, definitely. And that starting small, build up over time can be accredited to many things. Investments is one of them. So there's a great segment there. So obviously, I brought you on today because you have a vast knowledge of the bond market, fixed income area space, and you are often my go-to person when it comes to this area to see what's happening in the world. So for those people listening that don't understand, in simple terms, what is the bond market?
Yeah, so the bond market is one asset class which investors, particularly in Australia, may not be fully aware of. But like equities and like property, it forms part of a risk-return spectrum that investors can invest upon. Bonds are what's called, sits in the debt stack of a company that issues, and so comes with added protections and lower risk than equity in that particular company.
Yeah, perfect. And in terms of that debt stack, is that what they generally use for? Do companies issue bonds out there in order to kind of fund projects? Is it because the companies are going backwards? What's the purpose there?
Generally, it forms part of their funding mix for major banks in Australia, or for all banks in Australia. Rather, it forms part of their APRA regulatory capital. That's the capital that they need to issue to ensure that they are adequately placed to deal with financial hardship if and when that occurs. But for most companies outside of banks, other corporates, it's used for general corporate purposes, projects, etc.
Yeah, perfect. And if we look back on 2024 for this, so what was the performance like within the bond market and the drivers? Obviously, seeing it from my side, we've seen great growth within there, but I'd like to hear it from your side in that sense.
Yeah, it's interesting because in sort of in the last 12 to 18 months, we've really had rates sitting at fairly recent highs and not making a lot of moves, which means that the other side of the equation in terms of bond returns comes down, and particularly in the corporate space, comes down to credit spreads, and that's largely been what's driven bond price increases over the last 12 to 18 months. A couple of key factors can be credited to that in terms of credit spread contraction. But ultimately, it comes down to greater participation across, global markets, viewing Australia as a really, really right place for risk return in the corporate space.
Yeah, perfect. So in terms of if someone's looking to purchase bonds right now and stuff, would you say this is a good time, or has the past 12 months been a great time in that area?
I think what we've seen over the last 12 months, greater market participation, in corporate issues is likely to continue as well. But furthermore, what's about to become present, and it has been for a little while now, is the possibility of rate cuts, and that's the other side of the equation. With bond prices, you've got the base rates or yields, which are influencing prices, but then the credit spread as well. Whilst we see that credit spread contraction likely to continue, with weaker inflation and certainly weaker growth coming through, I think all four of our major banks expect the RBA to begin cutting rates at some point in the first half of next year, and that's going to further drive bond prices higher.
Yeah, perfect. So, if we're talking to everyday mum and dads here, what relationship does you talk about interest rates there? What relationship does the interest rates have with bond prices in terms of new issued bond prices as well as past bond prices there?
Yeah, so the relationship between interest rates or yields and prices are largely inverse for fixed rated bonds, i.e., in 2020, when we saw interest rates rising as a result of inflation, bond prices performed really poorly. And that's because of the inverse relationship. As yields increased, the prices went down. We're at a position now where it's likely that rate cuts are going to be occurring in this sort of, as I said, the next 6 to 12 months. And that's likely to result in prices increasing. Now, in terms of what you mentioned in primary markets versus secondary, there's also what's known as a new issue premium built into a lot of new issues which are entering the bond market, and that further sort of drives bond prices to perform, given that there's demand for that particular issue. But that's more on the credit contraction side as opposed to base interest rates.
Yeah, perfect. So if you've already got bonds and interest rates come down, and especially in that fixed area, you're sitting pretty. But obviously, there's your fixed portion and your variable portion. So right now, are you seeing a lot of people trying to get fixed bonds or the variable rate at the moment? And obviously, it's down to the issuer as well in that circumstance.
It is, yeah. And it's a good question. I mean, I think sort of 80% of the world's bonds are fixed rate. Most sovereign debt is fixed rate. However, there is a part of the market which is readily traded, which is floating. And going back to that example of the COVID and rising rates a few years ago, in anticipation of that, people were, and clients of mine were likely to be increasing their floating rate exposure, because essentially that means that as rates or yields rose, so did the distributions that they were getting paid on their bonds. Now we're in a position sort of working into the opposite, where we're likely to see rates being cut. So it's more prudent to have an allocation to fixed rated bonds. That said, most portfolios I see are sort of probably a 30 to 40% split between floating and then a 60% on the fixed side. So there still is some good income to be earned. The 3-month BBSW rate is still well above 4%. So for a coupon margin of 2%, you're still getting paid above 6%.
Yeah, perfect. And so, in terms of that, would you say a play for bonds is in just for the retirees, or still your wealth accumulators area? Because obviously, there's a lot of talk around it only focused amongst retirees. What would you say to that?
I think the age old adage is own your age in bonds as a percentage of your overall portfolio. So if you're beginning your wealth accumulation stage, late 20s, early 30s, it is prudent to have between 20 and 30% of your portfolio in safe defensive assets. That's purely because you never know exactly what fluctuations are going to occur in the market, and you need a stable part of your portfolio for rainy day scenarios. As you move into sort of middle age and retirement, it probably works well for you to increase that allocation over time. So whilst we do see the vast majority of clients, at or approaching retirement, more skewed in fixed income, it certainly makes sense to be increasing that throughout your investment life horizon.
Yeah, perfect. I actually quite like that. And I look back at a lot of my clients' portfolios, and they actually quite sit in that range as they get their retirement. 60 plus, it generally makes up around 60% of their fund, a mixture of those bonds and cash in there. So that does make sense in terms of that. And obviously, I do highlight that this is not financial advice. This is a general conversation on both sides. So do reach out if you're wanting to know about your portfolio there. Now, in terms of geopolitical events, so in 2024, we've had wars, we've had change of governments, elections. How does all those events really impact the bond market there?
Yeah, it's a good question. In terms of geopolitics, it probably plays more into the credit side of things. Recent events in France, for example, we've seen spreads on French-based banks widen as a result. Ultimately, we're pretty comfortable with the fundamentals of those banks, so it's probably short-lived. Similar to wars, I think the biggest risk at the moment is probably US and more so Trump in terms of what his policies may mean and the risks that associated with it in terms of possibly ramping up a bit of inflation again. A lot of his policies are fairly inflationary, tariffs, those sorts of things. So that's probably the biggest risk at the moment in terms of investment markets is what occurs as a result of his presidency.
Yeah, perfect. And obviously, getting in those fixed income ones could obviously benefit in that sense if you're locking in that price there. Now, one final question for our viewers here is, what's one thing you wish more people understood when it came to the bond market?
I think it's just the relationship between the inverse prices and with fixed rate bonds, and how that doesn't often occur with other parts of the market. Like we sort of earlier discussed, it was fixed bonds that ultimately sold off throughout that period of interest rate increases in 2020 and 2021. If you were reading the press, it was fixed income, bond NATOs. You hear it all. But bear in mind as well, like we discussed, there is another asset or another portion of that asset class, variable, floating. There's even inflation linked. So there's other portions of the market which investors can capitalize on to get the same defensive characteristics without being susceptible to falling prices as a result of yield increases. It's probably one of the biggest misconceptions I find.
Yeah, definitely. And look, I'll be honest. When I first got into the industry, it was definitely a misconception I had, that they all were directly linked until we went further down that route. So when the general public are just listening to the newspapers and the media regarding that, it's definitely, like you say, Armageddon within the industry when something happens, but it's not quite as what it seems to be in that sense. And what's it like in Australia in terms of the size of a bond market compared to the rest of the world?
Oh, we're extremely small in terms of relative to the rest of the world. Still in its relative infancy. You hear stories of investors in the States, talking about both equities and bond portfolios as part of their, Sunday barbecues. But in Australia, it's largely a rather undeveloped part of the market. That said, and sort of I think I highlighted a bit earlier, is that due to what's been happening in China over the last sort of probably year to year and a half, and we've seen a lot of global investors with Asia Pacific mandates start to really tap into the Australian fixed income market. We've seen investment grade issues over the last 12 months 5, 6 to 8 times oversubscribed. So there really is a growing demand for credit in Australia, and ultimately I think that's likely to continue.
Yeah, definitely. I only went to a presentation of yours recently, and you can definitely see the change in the market, the more uptake within the market, and just the availability of the options around there. It's definitely an area that is growing in that sense. So the last segment I like to do is plugs. So Adam, tell me what you got going on in your life. If there's anything you want to plug within the bonds, personally, how they relate in relationships or anything like that.
Oh, for me, it comes largely down to how I structure my personal life to ultimately perform from a professional sense. I'm big into my health and fitness, so it's about adopting a disciplined approach. With my training, completing small tasks, and then that gives me the confidence to continue growing as a person and to continue building my personal network in markets, and allows me to ultimately improve.
Yeah, perfect. Now I can't tell you that enough. I often see your stats on your running, and I try to ignore them, just knowing full well that I'm not doing those stats at all. But it definitely plays an impact on that side
Of
of things.
course, yeah. Although slightly demoralisingly, I've just clocked over 1,000 kilometres of running for the year, and which is for me a pretty big achievement, considering I hadn't started running until about 12 months ago. But then one of my mates kindly pointed out that a fairly popular running influencer did that in about a week recently. So it's 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 all about perspective.
It definitely is. You got, as you say, you got to start somewhere before you start growing. And on my side, if any questions come from our conversation with Adam today, please do not hesitate to reach out to me. If you want to get bonds within your portfolio, feel free to reach out. I can put you in contact with Adam. And lastly, as always, Lee, we will shamelessly plug the show. Do not forget to like and subscribe. Go to your favorite podcast and give us a 5-star rating or whatever you want. And if you want to reach out with any questions, please do not hesitate to reach out to me at ross@sternlightfinancial.com.au. I'd love to hear from you, any questions you have. So that's been another episode of the Founders and Finance podcast, and I look forward to hearing from you in the future. Thank you.